You know, the world of global finance, some of the most powerful signals are the ones nobody ever talks about. When currencies start to wobble, when liquidity dries up, when crises begin to form on the edges of the map, the headlines all point in the same direction: interest rates, central banks, recessions, GDP. But the people who manage real power, the ones sitting in reserve vaults, not in press rooms, they don't look at headlines. They watch something much older, something slower, something that holds a memory for longer than any chart you can pull up on a screen. They watch the movement of gold. I'm not talking about the price of it, but the physical metal itself, where it travels, which border it crosses, which vault it quietly leaves, which warehouse suddenly reports massive inventory adjustments. The truth is simple and a little uncomfortable. When gold begins to migrate, it means someone, somewhere, no longer trusts the financial architecture they once relied on. And they never announce that distrust. They express it in tonnage. Most people imagine gold just sitting in one place deep underground, in fortified rooms, watched by guards, locked behind tons of reinforced concrete. They picture stability, stillness, immobility. But that illusion is really only for the public. In reality, the global gold network moves in the same way that intelligence moves: silently, discreetly, often under diplomatic seal, without disclosure, and certainly without comment. Think about it: a pallet leaving a European vault in the middle of the night. A sudden, unexplained uptick of outbound shipments toward Asia. A single week where 3 different central banks quietly charter flights for strategic reserve transportation, and the paperwork is filed under generic commodity transfers. This is the part of the system the public never gets to see. Gold migration as a signal. Gold migration as a warning. Gold migration as the quiet, anonymous vote of no confidence in the existing order. The modern world likes to pretend it has outgrown gold, that digital money, reserve currencies, and sophisticated derivatives have replaced the need for something so primitive, so heavy, so inconvenient. Central bankers repeat this idea. Economists repeat it. Commentators on TV repeat it. But their actions tell a completely different story. When crises deepen, they do not ship derivatives across borders. They do not airlift government bonds to secret vaults. They move gold. They repatriate it. They request physical delivery from foreign custodians. They start rebuilding their own domestic vault networks. And they never, ever explain why. Because explaining would reveal the one truth they don't want on the record. No matter how advanced our monetary system becomes, when trust breaks down, the world still falls back on the oldest collateral of all. If you pay attention closely, you can actually sense when something is about to shift. Gold doesn't migrate randomly. It migrates with intent, with motive, and often, with a great deal of fear. Sometimes that fear is geopolitical, a sanctioned risk, a brewing conflict, a strategic divergence between former allies. Sometimes it's monetary and eroding confidence in the custodial system of another nation. And sometimes it's structural, a quiet, creeping realization that the global financial order, which is built on promises, swaps, offshore liabilities, and digital entries, might need something real and tangible underneath it. After all, what matters is simple. Gold only moves when the world's deepest, most powerful institutions feel something coming. Something they would rather cushion themselves against before the public even notices there's a problem. Something that makes them reach for the one asset whose movement leaves no press release, no forward guidance, no flashy headline, only a trail of metal moving through the dark. This isn't a new phenomenon. History is filled with these moments. Before World War I, European nations quietly, but urgently pulled their gold reserves back from London, the financial center of the world at the time. They sensed the coming storm long before the first shots were fired. The movement of the metal was the tell. Decades later, in the late 1960s, as the Bretton Woods system started to fray, France's Charles de Gaulle famously began demanding physical gold in exchange for his nation's U.S. dollar reserves. He sent the French Navy to New York to pick it up. It was a direct challenge, a physical act of defiance against a dollar he no longer trusted. That move was a major crack in the foundation of the post-war financial system, a crack that led directly to the collapse of the gold standard in 1971. The pattern is always the same. Publicly, leaders express confidence. Privately, they move their gold. So, where's the gold moving today? The data, though intentionally murky, points to a clear and historic trend. Over the last decade, there has been a massive, sustained flow of physical gold from west to east. From the vaults of New York and London to the vaults of Shanghai, Moscow, and Istanbul, central banks in countries like China, Russia, Turkey, and India have been on an unprecedented buying spree. But they aren't just buying paper contracts. They are demanding physical delivery. They are taking their gold home. Why? Look at the geopolitical landscape. We're seeing the rise of a multipolar world. The unshakable dominance of the U.S. dollar is being openly questioned for the first time in generations. Nations are forming new economic blocs, like BRICS, and are actively seeking alternatives for trade and reserves. When you see a country like Russia get its foreign reserves frozen overnight, what do you think the finance minister of every other non-Western nation thinks? They think, my reserves are not safe if they are held in a jurisdiction cannot control. And what is the one reserve asset that cannot be frozen with a keyboard stroke? Physical gold, held in your own vault. This isn't about being pro-East or anti-West. It's about risk management at a national level. It's about financial self-preservation. When trust in the global referee, the United States, and its financial system begins to erode, nations will naturally seek assets that are outside that system's control. Gold is the ultimate neutral asset. It has no counterparty risk. Its value isn't dependent on the full faith and credit of any single government. This repatriation trend is accelerating. We've seen Germany, the Netherlands, Austria, and others all undertake massive, multi-year operations to bring a significant portion of their gold back home from New York and London. Publicly, they offer vague reasons like auditing purposes or updated storage policies, but the real reason is clear. In a world of increasing uncertainty, you want your most valuable emergency assets within arm's reach. You don't want them held hostage by the political whims of another country, even an ally. So, what does this all mean for you? It means that the very foundation of the global financial system is quietly being reshuffled. While the news is filled with daily market noise, the smart money at the sovereign level is making long-term, strategic moves. They are de-risking. They are diversifying away from a unipolar, dollar-centric world. They are preparing for a future that might look very different from the past 50 years. This isn't a prediction of doom. It's an observation of behavior. It's a recognition that the tectonic plates of global power are shifting, and the flow of physical gold is one of the most reliable seismographs we have to measure it. The institutions with the longest time horizons and the most to lose are placing their bets not on promises, but on physics, on a dense, inert, yellow metal that has outlasted every empire and every currency in history. To understand why gold is still moving across borders today, and why those movements matter more than any speech from a politician, you need to know the real history, not the one they rewrote for us. Let's go back to 1914. When Europe plunged into war, the first thing to break wasn't a battle line. It was the trust line. Governments had to stop converting their paper money into gold. Not because they wanted to, but because war costs a fortune. They needed to print money, and you can't print money if you're tied to a finite amount of metal. Once that promise was broken, it was never truly fixed. The years between the wars were a slow-motion train wreck of monetary confidence, all disguised as financial progress. Countries tried to go back to gold, but they got it all wrong. They used the wrong prices, they didn't have enough reserves, and their debts were massive. Britain, for example, stumbled back onto the gold standard in 1925 at a disastrously high rate. The pressure was too much, and within 6 years, their system imploded. Banks collapsed, currencies tanked, and money fled the country. The whole thing fell apart right where the gold was weakest. Meanwhile, across the Atlantic, the United States was quietly building the largest gold hoard in human history. It was like a giant financial vacuum, pulling all the metal out of a struggling Europe. By 1933, the U.S. dollar was backed by a literal mountain of gold, so big that it gave Washington the power to design the entire world's financial system after World War II. That's exactly what they did. At the Bretton Woods Conference in 1944, gold was officially made the anchor of the new global system. But there was a catch. Only the U.S. dollar could be converted directly into gold. Every other country would hold dollars as their reserve, trusting that America would always honor its promise to convert those dollars into gold if asked. The U.S. held the gold, the world held dollars, and everyone relied on the assumption that America would never lose control. For a while, this illusion of stability worked. From the late 1940s into the early 1960s, the gold just sat there. It was locked in vaults in New York, Fort Knox, London, and Paris, untouched and unchallenged. The world believed that this system meant stability, and stability meant trust. But under the surface, the cracks were already starting to show. Europe was rebuilding, Japan's economy was taking off, and global trade was booming. The number of U.S. dollars circulating outside of America was growing much faster than the gold backing them up. These foreign-held dollars became like shadow claims on America's gold. If too many countries decided to cash in their dollars for gold at the same time, the entire system would collapse. By the early 1960s, other central banks started noticing this dangerous mismatch. They didn't write articles about it or warn the public. They didn't call for a big global meeting. They just quietly started asking for their gold back. France, led by Charles de Gaulle, was the most direct. In a move that sent shockwaves through Washington, the French government literally sent warships to New York to collect its gold. They were choosing cold, hard metal over paper promises, reality over rhetoric. Other countries followed, but much more quietly. Gold shipments moved in the dead of night. Diplomatic crates passed through customs under seal, their contents a state secret. All the while, the U.S. government insisted everything was fine, that the dollar was as good as gold. But the metal leaving the country told a completely different story. It was a silent vote of no confidence. The world no longer trusted the anchor of its financial system. The clock was ticking. By 1971, the pressure was unbearable. The U.S. might have been the world's biggest economy, but even it couldn't defend a promise when there were far more claims on its gold than it had gold to honor them. On August 15th, President Nixon went on television and suspended the dollar's convertibility to gold, effectively killing the Bretton Woods system. The headlines called it a strategic policy decision. In reality, it was the final domino to fall in a chain reaction that had started a decade earlier with quiet shipments of gold. The collapse didn't begin with a war or a speech. It began with central banks bringing their gold home. The movement of gold was the canary in the coal mine. The reset of the global monetary system was the mine collapsing. After 1971, the public was told that gold didn't matter anymore. Economists called it a barbarous relic. Journalists said its role was obsolete. Governments claimed that modern fiat currencies, money backed by nothing but faith, were stronger, more flexible, and more advanced. We were told we had evolved beyond a primitive attachment to shiny metal. And yet, behind the curtain, the actions of these same governments told a very different story. Even after they supposedly abandoned gold, the world's major economies continued to hold on to massive gold reserves. The IMF kept thousands of tons. The United States held onto its more than 8,000 tons. European nations kept their stockpiles in deep, secure storage. Even the Soviet Union, which didn't trust the Western financial system, made sure to build its own huge stockpile of gold. While everyone's eyes are glued to digital currencies and stock market tickers, a silent, heavy migration is happening in vaults across the globe. This isn't just about economics. It's about geopolitics. It's a story the headlines miss, but history never forgets. Let's rewind. China, long before it became a global financial powerhouse, was quietly buying gold. India, knowing how volatile its currency could be in a crisis, stacked up gold reserves. Even Germany, decades after World War II, insisted on bringing its gold back home from New York and Paris. They called it a logistical reassessment, but everyone knew what it really meant. We want our gold on our own soil. If gold were just a shiny relic, none of this would be happening. The most fascinating chapter of this story, though, began in the 90s and 2000s. This was the era of peak globalization, the dawn of digital finance, and the explosion of complex derivatives. Gold should have become irrelevant, a historical curiosity. But something strange happened. The very same central banks that had spent years dismissing gold started buying it again. Quietly, consistently, with no fanfare. Emerging markets were the first to move. China, Russia, Turkey, Kazakhstan, they all started accumulating gold. Then, a bigger shift. Europe stopped selling. Even countries with stable, powerful currencies held onto their gold reserves with a surprising firmness. Why? Because they understood something fundamental. Digital assets can be created out of thin air, but gold cannot. It represents a final form of settlement, a bedrock of trust when all other systems are shaking. Then came 2014, and the geopolitical chessboard was overturned. Tensions rose, and the quiet movement of gold turned into a noticeable migration. Russia, anticipating Western sanctions, moved hundreds of tons of gold into its own vaults, creating a financial fortress. China accelerated its purchases, though it didn't announce every transaction. Other nations, feeling pressure from the U.S., began quietly repatriating their metal. The flow was subtle, but for those paying attention, the signal was unmistakable. Look back through history, and you'll see a recurring pattern. Every major monetary earthquake in the last century was preceded by this kind of gold movement. In the 1930s, as trust in the global financial system collapsed, gold fled a nervous Europe and flowed into the safety of America. In the late 1960s, as the Bretton Woods system began to crack under pressure, gold moved out of America and back into Europe, especially France. The U.S. couldn't honor its promise to redeem dollars for gold, and the system broke. In the 1990s, when emerging markets from Asia to Latin America faced devastating currency crises, gold acted as a stabilizer for countries whose banking systems were failing. And during the 2008 global financial crisis, what happened? Gold prices surged as governments and investors alike scrambled for a safe haven, forcing a deep reassessment of what reserve asset truly means. And now, since 2014, a new pattern has emerged, one that speaks volumes about our current world. Gold is leaving the traditional Western custodians in London and New York and moving east to Asia, the Middle East, and other emerging powers. This isn't a random fluctuation. It's a strategic realignment. What makes this movement so critical to understand is what gold is not. Gold is not fast money. It doesn't chase high yields or quarterly returns. It doesn't follow fads or speculative narratives. Gold follows fear. It follows distrust. It follows long-term, strategic planning for a world that might look very different tomorrow. When a government moves physical gold across borders, it's not a simple accounting entry. It is a profound statement. It's preparing for a future where trust might break down. A world where your foreign custodians might not be so reliable anymore. A world where digital assets can be frozen with the keystroke, but a physical bar of gold in your own vault cannot. It's preparing for a world of shifting alliances and fragile monetary orders, where the old rules may no longer apply. The world has changed dramatically since 1971, the year the U.S. officially severed the dollar's link to gold. We live in a digital age, an era of instant global transactions, but the fundamental logic of power and security hasn't changed at all. Gold still moves when the very foundations of global finance begin to shift. In the quiet moments, long before the panic hits the markets, long before the crisis makes the front page news, central banks vote with their vaults. They don't move tons of metal because they want to deal with the hassle and expense. They do it because they believe they might soon need to. That's the real history, the part you won. Find in most textbooks, gold migration as the ultimate canary in the coal mine, a precursor to systemic change. And today, that signal is back, louder than it has been in decades. Countries that once felt perfectly comfortable leaving their national treasure in vaults abroad are now bringing it home. Nations that once dismissed gold as a symbolic asset now treat it as a critical, strategic one. The flows of gold, which were once small and ceremonial, are now moving in bulk. This is not a coincidence. This is not driven by nostalgia for a bygone era, and it's certainly not irrational. It is preparation. It is the kind of quiet, deliberate preparation that has preceded every major monetary pivot the world has ever known. History, after all, doesn't repeat itself in the headlines you read every day. It repeats itself in the silent, unexplained shipments of physical gold moving from one part of the world to another, signaling a future that is yet to arrive. For decades, the arrangement was simple. Central banks around the world kept their gold reserves safely tucked away in Western vaults, mostly in places like London and New York. Why? Because they trusted the framework. They believed in the treaties, the legal protections, and the unspoken guarantee that their gold was safe. It was a system built on mutual confidence. But something broke. Starting in the 2010s and picking up speed in the 2020s, that trust began to crumble. Events that were once considered impossible suddenly became reality. We saw sovereign assets frozen overnight. We saw a major G20 nation get locked out of hundreds of billions of its own foreign reserves with just a few signatures. The very tools of global finance, payment networks, reserves, assets were being weaponized. This wasn't just a news headline. It was a wake-up call for every central banker on the planet. The quiet panic began. Because if the new rules of the game mean your country's savings can be frozen, seized, or politically blocked, then holding your most important asset abroad suddenly makes no strategic sense. Think about it. Modern digital reserves can be switched off with a keystroke. A physical bar of gold in your own vault cannot. This realization started as a murmur in policy meetings, then a whisper among reserve managers, and finally, it turned into a silent but undeniable shift in behavior. Gold started going home. Country after country began quietly repatriating its bullion. This wasn't about preparing for a return to the gold standard. It was about something much more fundamental: custody risk. The risk that someone else holding your assets might not give them back had returned to global finance. This kind of risk hadn't been a serious concern since the turbulent years between the world wars, a time when gold movements often signaled a coming currency collapse. But now, it's back. In a world where global powers are drifting apart, where sanctions are becoming more common and more severe, gold held abroad is no longer just an asset. It's a vulnerability. And if there's one thing central banks absolutely hate, it's a vulnerability they can't control. So, they are moving to eliminate it. This is where the story gets really interesting. The massive movement of gold we're seeing today isn't about the price, or inflation, or market speculation. It's about jurisdiction. Every cargo plane filled with gold flying from London back to its home country, every quiet transfer from a New York vault to a domestic one is sending the same hidden message. The global reserve system is being fundamentally restructured right under our noses. When Germany demanded its gold back from the U.S. and France, the official story was logistical optimization. But it took years to complete, and behind the scenes, the message was clear. Even among close allies, trust is no longer absolute. When countries like Turkey, Russia, and many others dramatically increased their gold purchases while pulling their existing metal out of Western vaults, commentators called it diversification, but insiders knew the real reason. They were de-risking. They were reducing their exposure to a financial system where trust had become fragile and conditional. The more you look at the data, the clearer the pattern becomes. Gold is no longer just moving randomly. It's clustering. It's flowing towards jurisdictions where nations believe they can maintain total control over their own reserves. It's moving to vault systems outside the legal reach of the West. It's moving to nations that are building their own high-security storage for the first time in decades. And once you see this clustering, you understand the deeper, more profound implication. When trust in the physical custody layer of the system erodes, it's a sure sign that trust in the entire monetary layer is already weakening. This is the part almost no one outside the system gets. Most people think a financial crisis starts with a market crash or a bank failure, but in the rarefied world of central banking, the crisis begins long before that. It begins in the vault. It starts when the people in charge sense that the global system, the one supporting trillions in digital claims, is no longer as stable, cooperative, or politically neutral as it once was. This pivot doesn't announce itself with a press conference. You won't hear a finance minister declare, "We are preparing for the global financial system to fragment." No, the signals are much more subtle, hidden in the physical world. You'll see new deep storage facilities being built under government ministries instead of commercial banks. You'll find air freight insurance policies being expanded to cover massive bullion shipments. You'll see quiet government tenders for armored transport companies. These are not just random administrative tasks. They are structural adaptations for a new era. They tell us that the world's most powerful financial institutions are positioning themselves for a future where the safety of their reserves isn't guaranteed by alliances or market norms, but by one simple thing: physical possession. And here lies the heart of the twist. This historic migration of gold isn't a reaction to a crisis that has already happened. It's an anticipation of one that is yet to come. Gold is moving before the rupture, not after it. It's moving before the next great monetary realignment, not during it. It's moving before the next geopolitical fracture becomes obvious to everyone else. Gold is moving the same way animals flee a forest minutes before an earthquake hits. They don't understand the science of plate tectonics, but they can feel the ground shifting beneath their feet. Most people won't notice this. Traders will stay glued to their price charts. Analysts will debate interest rate cuts. Pundits will argue about inflation. But the real story, the most important signal, isn't coming from the markets. It's coming from the pallets of gold bullion crossing borders in the dead of night, in complete silence, hinting that the world's deepest and most powerful institutions already know something the public does not. To understand why nations are moving gold like never before, you have to forget everything you think you know about it. Forget the price tickers, the myths, and the treasure stories. Instead, look at the hidden machinery that governs how gold is stored, moved, and weaponized by governments. The first rule of this machinery is shockingly simple. Physical gold is the only reserve asset that a foreign government cannot freeze. Think about it. Dollars can be frozen. Government bonds can be immobilized. Bank reserves can be blocked. Even foreign currency held abroad can be seized. But gold, once it's physically inside a country's borders, becomes immune to external financial control. This immunity is the silent truth behind every secret shipment and every new vault. And since immunity requires possession, the strategic game of gold all starts with one question: where is it located? The moment a gold bar leaves a vault in London or New York and lands in a domestic one, it sheds a layer of risk that almost every other financial asset carries. This is why the real story isn't about the price of gold, but about its custody. In today's world, a ton of gold in London serves a completely different purpose than a ton of gold in Beijing, Moscow, or Ankara. A gold bar in a London vault is part of a global system. It gets lent out, swapped, and used as collateral in complex financial deals. But that very same bar, once flown across a continent and locked away in a national vault, leaves that system entirely. It becomes what's known as sovereign reserve stock, untouchable, unencumbered, and safely outside the reach of foreign political pressure. This split between global gold and domestic gold is the key to understanding the massive migration happening right now. Central banks aren't just moving metal, they are fundamentally changing its purpose. They are converting their international gold into sovereign gold, quietly dismantling an old system while building a new one in parallel. To see this in action, you have to follow the logistics, a process that governments deliberately keep secret through coded reports and vague disclosures. When a central bank decides to bring its gold home, the planning starts months before any shipment is made. Insurance contracts are renegotiated in secret. Secure logistics firms are hired under strict non-disclosure agreements. Audits are performed, and serial numbers are reconciled. The entire operation looks more like military planning than financial management. A single flight carrying repatriated gold requires coordination between central banks, air carriers, security agencies, and often, intelligence services. The gold is moved in armored convoys under diplomatic seal, frequently escorted by armed personnel, and all of this happens without any public announcement, because advertising your vulnerability before the asset is secure would defeat the entire purpose. The sheer complexity and cost mean that countries only repatriate their gold when the incentive becomes overwhelming. This brings us to the second layer of this mechanism. Bringing gold home is a sign of existing stress in the system, but buying new gold, that's a sign of future stress. When countries start aggressively accumulating gold, especially when they don't fully report their purchases, it's a signal that they're preparing for a world where their other reserves might fail them. Take China, for instance. Its official gold purchases are just one part of the story. The People's Bank of China is widely believed to buy gold through state-owned banks and other entities, quietly adding it to its reserves later. The real volume is almost certainly much higher than what they officially report. We see similar patterns in Russia, Turkey, India, and several Gulf states. They aren't just growing their gold reserves, they are strategically relocating them. If you zoom in on the global flow of gold, a powerful trend becomes clear. Gold moves toward where trust is weakest, not where financial returns are highest. In normal markets, money chases the best investment return. But in the world of national reserves, it's the absence of trust that drives the biggest decisions. After 2014, when financial sanctions became a primary tool of foreign policy, nations around the world began to question the safety of their assets held abroad. Russia moved hundreds of tons of gold into its domestic vaults. Turkey accelerated its own purchases and reclaimed its gold from London. Poland repatriated gold from the UK, citing the need to enhance economic security. Even allies of the U.S., like Austria and Hungary, started rebalancing their gold storage to bring more of it home. The logic in every case was the same. The global system had changed. A country's legal reach over its assets had suddenly become more important than financial liquidity. To fully grasp this, we need to look at the gold leasing market, a sort of shadow engine for global finance. In London, central banks and major financial institutions participate in gold leases, where physical gold is lent out for a return. This borrowed gold can then be sold, released, or used as collateral, creating complex chains of claims on the very same underlying metal. It's an efficient system, but it has a huge vulnerability. It only works if everyone deeply trusts each other. When a country pulls its physical gold out of this network, it's like pulling a foundational piece out of the entire structure. The available collateral shrinks, liquidity tightens, the market shifts. Withdrawing a few tons is a minor event. Withdrawing hundreds of tons, as we're seeing now, fundamentally changes the architecture of the market. The global gold leasing system has been quietly shrinking, not because there's less demand, but because the supply of lendable gold is being pulled into sovereign vaults where it cannot be touched. This trend reveals a fascinating split. Gold is slowly bifurcating into two distinct markets. There's financial gold, which trades, leases, and circulates within the Western financial system. And then there's sovereign gold, which sits inactive but powerful in national vaults, serving as geopolitical insurance. This brings us to the final, most strategic layer. Once gold enters the sovereign market, it becomes a dormant but incredibly potent asset. It can be used to back a currency during a crisis. It can anchor political stability in the face of sanctions. And crucially, it can be used as the ultimate settlement collateral in trade between nations that are trying to move away from the dollar. This is where gold meets energy, where a ton of metal can replace a line of credit, and where physical settlement can bypass vulnerable payment systems. Once that gold is sitting securely at home, a new game begins. This isn't about speculation or market hype. This is about gold as the ultimate settlement collateral. In a world where trust between nations is fraying, the very systems that move money across borders like SWIFT or CHIPS are no longer neutral territory. They've become political battlegrounds. The US dollar's dominance gives Washington control over who can and cannot make payments. Europe has its own rules. China is building an alternative, but it's still a small player on the global stage. For countries trying to shield themselves from sanctions or currency shocks, These systems are a source of vulnerability. They need an anchor that can't be disabled by a foreign power. And that anchor isn't a new app or a digital currency. It's gold. Think about it. When two countries trade using their own currencies, one inevitably ends up with the surplus of the other's money. How do you balance the books without a trusted asset? That's where gold comes in. No one can print more of it, freeze it, or weaponize it once it's in your vault. This is the foundation for the new bilateral trade routes emerging across Asia, the Middle East, and Africa. They're not built on blind faith. They're built on the quiet understanding that any trade imbalance can be settled with physical metal. A country selling oil might accept payment in rupees or yuan, but it wants a gold-backed guarantee so it doesn't get stuck with the currency it can't use. This is why the great migration of gold to emerging markets is so critical. It's not symbolic, it's infrastructural. It's about building options into the global trade system. Hidden from public view are complex arrangements like gold swaps and collateral pledges. A central bank can pledge its domestic gold to secure a loan in another currency, all without a single bar leaving the country. These secret agreements are the invisible wiring of a world slowly moving away from total dependence on the dollar. Every ton of gold brought home strengthens a nation's hand in these negotiations, because that gold is beyond the reach of foreign courts. Western policymakers often dismiss this as a fringe activity, but central bankers aren't listening to political speeches. They're managing risk, and the last decade has taught them one thing: keeping your reserves abroad is a huge vulnerability. The numbers tell a story the headlines often miss. Since 2014, central banks have been on a historic buying spree, adding over 5,000 tons to their official reserves. China's reported holdings have soared, and many believe its actual stash is much, much larger. Russia quadrupled its gold stockpile and brought nearly all of it home. Turkey, India, Qatar, and even countries like Poland and Serbia have made massive purchases and repatriations. At the same time, Western central banks have become much less willing to lease out their gold. The supply has tightened. This isn't just a cycle, it's a structural change. It becomes even clearer when you look at how gold behaves during a currency crisis. Countries like Thailand, South Korea, and Argentina learned the hard way that foreign currency reserves can vanish just when you need them most. But gold held at home? That's a lifeline. It becomes the ultimate backstop for the state itself, allowing it to restore confidence when all else fails. This is why emerging markets value gold so much more than developed nations. They've lived through the pain of financial fragility. For them, gold isn't about nostalgia. It's about survival. And this survival logic is spreading. Energy giants like Saudi Arabia and the UAE are increasing their gold reserves to reduce their reliance on a single currency. Even developed economies like Germany, the Netherlands, and Austria have brought huge amounts of their gold back home after re-evaluating the risks. These aren't coordinated actions, but they all point to the same conclusion. The world is becoming a more uncertain, multipolar place, and gold is the ultimate insurance policy. Look at where the gold is physically going. For decades, London and Zurich were the undisputed centers of the gold world. Now, new hubs are rising in Dubai, Shanghai, and Singapore. China, for instance, requires that all imported gold be refined and registered on the Shanghai Gold Exchange, effectively pulling that metal into a system from which it rarely returns. The Middle East is building massive new vaults, creating a logistics chain independent of the West. These geographic shifts show that gold is moving toward the regions that anticipate the most disruption. In a world splintering into competing currency blocks, one centered on the dollar, another on the yuan, gold becomes the only truly neutral asset. It's the bridge between systems. It's the one thing everyone can agree on without signaling political allegiance. This is why the buying is global. Countries aren't betting on a collapse. They're betting on uncertainty. And in a world of uncertainty, gold is the only reserve asset that doesn't depend on another country's promises. The final layer here is the most powerful. When a country repatriates its gold, it's sending a message without saying a word. It's a message to allies that trust has its limits. It's a message to rivals that resilience is being built. And it's a message to the world that it will not be cornered. This message isn't delivered in speeches. It's delivered on pallets of metal, on cargo planes that land in the middle of the night. When enough countries send the same signal, it becomes a global phenomenon. Gold isn't moving because traders are excited. It's moving because policymakers sense risk. Every shipment is a quiet warning. Every purchase is a strategic adjustment. We are witnessing the mechanics of a world preparing for a fundamental monetary rearrangement, long before it ever hits the headlines. The Great Migration of gold isn't a reaction to change. It is the preparation for it. We often talk about gold in terms of its price. Does it go up? Does it go down? But what if that's the wrong way to look at it? What if the real story of gold isn't about charts and figures, but about something much deeper? Something happening right now, quietly, behind the scenes. The truth is, gold moves when confidence doesn't. It migrates when the very foundations of global finance start to shift in ways no one dares to speak about aloud. And right now, those movements are telling a story that markets haven't even begun to price in. Think about it. We're seeing nations repatriating their gold reserves, bringing them home from vaults in London and New York. They're not doing this because of some old superstition or a sentimental attachment to shiny metal. They are doing it because they sense that the monetary world we have known for the last 50 years is entering a new phase. In this new era, things like geopolitical alliances, who you trust to hold your assets, and your ability to make payments without permission matter more than ever. Gold isn't a signal of a coming collapse. It's a signal of preparation. But preparation for what? That's the multi-trillion-dollar question hanging over every secret shipment, every new high-security vault, and every unexplained jump in central bank buying. If you step back and look at the pattern, a sobering picture emerges. The US dollar isn't going away, but its dominance is becoming more conditional. Digital payment systems aren't failing, but they are becoming political tools. And while sanctions are nothing new, their reach is now extending deep into the core plumbing of global finance. In a world where access to your own money can be blocked with the stroke of a pen, countries are relearning a very old lesson. Sovereignty without control over your own reserves is just an illusion. This lesson is driving quiet decisions all over the world. It's changing how trade is settled, how national savings are structured, and how countries hedge against risk. So, gold's resurgence isn't about going back to the past. It's about adapting to a future where certainty is a much rarer commodity than cash. The real danger here is that by the time the general public recognizes these signals, the game will have already changed. Markets are noisy. They react to headlines and tweets. But systems, the deep structures of global power, move silently. The reconfiguration of reserve assets, the quiet formation of new payment channels between countries, the distinction between financial gold held for trading and sovereign gold held for survival, these are market events you all see on the evening news. They are structural adjustments that happen long before a crisis ever breaks out. By the time the consequences show up in your currency's exchange rate in the bond markets or in global capital flows, the truly important decisions will have been made years earlier in rooms without cameras and inside vaults without windows. The warning isn't that the current system is about to be abandoned. The warning is that a parallel one is being built, piece by piece, in the background. Some countries are preparing for a world that's more fragmented. Others are getting ready for the return of powerful geopolitical blocs. Some are hedging against sanctions that might one day target them. And many are simply preparing for a world where alliances shift faster than institutions can keep up. But they are all operating on the same unspoken premise. Trust is no longer an infinite resource. Therefore, you can't build your nation's security on infinite assumptions about your allies. The takeaway for you and me is simple, but it's also unsettling. If you want to understand where the world is really heading, don't just listen to the speeches from politicians or the forecasts from economists. Don't just follow the market narratives. Look at the metal. Look at where it's physically located. Look at where it's going. Pay attention to who is building new vaults, who is quietly expanding their reserves, who is pulling their gold out of global circulation, all while publicly insisting that nothing is changing. Gold doesn't move unless someone, somewhere, senses a fundamental shift is underway. And today, it is migrating more broadly, more strategically, and more purposefully than at any point since the last major monetary reset. When gold moves across borders, it's not just an economic event. It's a geopolitical one. It is the sovereign equivalent of a whispered warning. It tells you which nations believe the future will look like the past, and which ones are betting it won't. And when you see enough of these warnings, when enough of these shipments form a clear pattern, you start to understand what the world's most powerful institutions will never say directly, that the system beneath global finance is bracing for another turn, another redesign, another chapter in its history. You were never really meant to see these signals. They happen in the shadows. But now that you have, you can't ignore them. The metal is moving for a reason.